If you keep doing what everyone else is doing with money, you will end up exactly where everyone else is. And let me tell you something, most people are not where you want to be. They are stressed, in debt, and constantly trading their time for money. Now here's the crazy part. The system actually works perfectly, just not for you, unless you understand how to play the game. And today, Money Monkey is going to show you how to stop being the banana and start owning the jungle. Monkey Money Bag. What's up, everyone? Welcome back to Money Monkey, the only channel where a monkey in a jungle explains money better than most humans in suits. No complicated talk, no hype, just simple strategies that actually work. Now, let's get real for a second. Most people think the problem is they don't make enough money. But that's not the real problem. The real problem is what they do with the money they already have. And if you don't fix that, no salary in the world will make you wealthy. You can earn $3,000 a month, spend $3,200, and stay broke. Or you can earn $3,000, invest $500, and slowly build freedom. It's not about income first. It's about behavior. So today, I'll break down the biggest financial mistakes that keep people stuck. And more importantly, how you can escape that cycle using simple investing strategies like ETFs. Let's start with the first big mistake. Spending money you don't have, or as I like to call it, banana borrowing. You eat the banana today, but tomorrow you owe 2 bananas back. Cars, credit cards, lines of credit. These are the 3 traps. Most people don't ask, "Can I afford this?" They ask, "Can I afford the monthly payment?" That's a completely different question, because monthly payments hide the truth. A 3,000 car suddenly feels cheap when it's only $500 a month. But that's exactly how the trap works, because a car is not an asset. It's a liability. It loses value every single year. After 5 years, that car might be worth half of what you paid. And if you financed it, you paid interest on top. So you lost money on value and paid extra for it. That's like buying a banana, watching it rot, and paying interest while it disappears. Money Monkey does not approve. Now let's talk about credit cards. This is where things get dangerous. Interest rates of 15 to 25% are common, some even higher. And here's something most people don't realize. If you carry debt long enough, you can pay back several times what you originally spent. That small purchase today becomes a very expensive mistake tomorrow. Now flip that idea. Instead of paying 20% interest, what if you earned it? That's exactly what investing allows you to do. Which brings us to the next mistake. Only being a consumer. In this world, there are 3 roles: consumers, investors, entrepreneurs. Most people stay in the first category forever. They work, earn money, and spend it, over and over again. They buy products, subscriptions, upgrades, things they don't even remember buying. And every time they spend, someone else profits. But investors do something different. They take their money and buy assets, stocks, ETFs, real estate, things that generate more money over time. That's how wealth is built. Not by working more hours, but by owning things that work for you. And here's where ETFs become incredibly powerful. An ETF is a collection of companies bundled together. When you buy one ETF, you're investing in hundreds, sometimes thousands of companies at once. That means you don't need to guess which company will win. You own all of them. Some go up, some go down. But overall, the market tends to grow over time. That's why ETFs are considered one of the safest and simplest ways to start investing. Even for beginners, even for busy people, even for monkeys sitting in a jungle with Wi-Fi. Now let's talk about another major mistake: relying on others for your financial future. Governments, pensions, systems. Here's the honest truth. These systems were never designed to make you wealthy. They are designed to support you at a basic level. And in many countries, that support is becoming weaker over time. More people retiring, fewer people paying into the system. That creates pressure, which means uncertainty. So if your entire plan depends on something you don't control, that's risky. Money Monkey always says, hope is not a strategy. Ownership is. Then there's the trap almost everyone falls into at some point, chasing quick money. The hot stock, the viral crypto, the secret strategy, the course that promises financial freedom in 6 weeks. Look, it sounds exciting. And yes, a few people make money. But most people lose because they enter late, they follow hype, and they panic when things drop. Wealth is not built in days. It's built in years. Consistent investing, patience, discipline. That's the boring truth. And yes, boring is good. Because boring makes money. Exciting usually loses it. Money Monkey has seen many monkeys jump from branch to branch, chasing shiny bananas. Most of them fall. Hard. Don't be that monkey. Another mistake that sounds smart but isn't enough is saving all your money. Saving is important. You need security. You need an emergency fund. But saving alone will not make you wealthy. Because of inflation. Every year, your money loses purchasing power. What 100 buys today might only buy 90 in a few years. So if your money just sits there, it's slowly shrinking in value. Investing is what grows it. That's where ETFs shine again. They allow your money to grow with the economy. Companies innovate. They sell products. They increase profits. And as an investor, you participate in that growth. Now let's make this very real. Imagine you invest $200 every month into a broad market, ETF. Nothing fancy, no stock picking, just consistency. Let's assume an average return of 8% per year. After 10 years, you have around $36,000. After 20 years, about $120,000. After 30 years, over $300,000. Now here's where it gets interesting. Out of that $300,000, a big portion is not your money. It's growth. It's compounding. Now imagine you increase your investment over time. Maybe you start with 200, then go to 300, then 400. Suddenly, you're not looking at 300,000 anymore. You're looking at 500,000, 600,000 or more. That's how normal people build wealth. Not overnight, but step by step. Another important point. Do not treat your investments like a savings account. This is long-term money. The market will go down sometimes. That's normal. If you panic and sell, you lock in losses. If you stay invested, you give your money time to recover and grow. Even the best investors in the world have losses. That's part of the game. The goal is not to avoid losses completely. The goal is to win over time. So what should you actually do? Start simple. Stop unnecessary debt. No more high-interest traps. Build a small emergency fund. 3 to 6 months of expenses is a good start. Then begin investing. Monthly. Automatically. Even small amounts matter. 50, 100, 200. Consistency beats intensity. Use ETFs if you're a beginner. They reduce risk and simplify everything. Stay consistent. Ignore short-term noise. Focus on long-term growth. And one of the most powerful strategies, don't inflate your lifestyle too quickly. When you get a raise, don't upgrade everything immediately. Upgrade your investments first. That's how you create momentum. That's how you escape the cycle. At the end of the day, you don't need to be a financial expert. You don't need perfect timing. And you definitely don't need luck. You need a plan. You need discipline. And you need patience. Most people won't do it. Not because it's hard, but because it requires consistency. And consistency is not exciting, but it works. And remember, you have 2 choices. Spend money and make others rich, or invest money and build your own future. One leads to stress. The other leads to freedom. Even a monkey knows which one makes more sense. This is Money Monkey. And I'll see you in the next video. Monkey Money Bag.